Welcome to The Explainer. Today, we're going to crack open the books to get right to the heart of any business that makes things. We're talking about manufacturing and the all-important process of figuring out the true cost of production. So let's just jump right in with a question. Imagine you're Mr. Vimmel, and you run a factory that makes soap. You've got to answer a simple but surprisingly tricky question. What does it actually cost you to make a single bar of soap? You know, your first thought is probably just the ingredients, right? The oils and fragrances. But hold on a second. What about the wages for the worker who mixed them? The electricity for the machines? What about the rent for the factory building itself? All of a sudden, it's not so simple. This is the manufacturer's dilemma. To set a good price and find your actual profit, you have to know your total cost to create your product. To solve this exact problem, accountants came up with a special tool, the manufacturing account. Its one and only job is to gather up every single cost related to production in one place, so that at the end of the day, you know the total cost of all the finished goods you produced. Okay, let's get into it. We're going to build this total cost from the ground up, starting with the most direct and obvious expenses. This first essential building block is known as the prime cost. The prime cost is basically the sum of three core components, all directly tied to the physical creation of the product. Now, we're going to focus on breaking down that first one, raw materials consumed, because how you calculate it has a few important moving parts. All right, let's tackle that first component, raw materials consumed. Now, this isn't as simple as just adding up your purchase receipts for the year. The key word here is consumed. We have to figure out the value of the materials that were actually used in production, which means we have to account for our inventory. Okay, let's run the numbers for Mr. Vimmel. The formula is pretty simple. You take your starting inventory, add what you purchased, and then subtract what was left at the end. First up, the starting point. He already had 1,70,000 rupees worth of materials in his warehouse when the year began.
To that, we add in all the new supplies he bought throughout the year, which comes to another 8,20,000 rupees.
And finally, and this is the key step, we have to subtract the value of the materials that weren't used. At the end of the year, when he took stock again, he still had 1,90,000 rupees worth of materials left over. So, if we take that starting stock of 1,70,000, add the purchases of 8,20,000, and subtract the 1,90,000 he had left over, we get our final number. The actual cost of raw materials consumed was 8 lakh rupees. This is the figure that truly matters for our production costs. Okay, so we've nailed down our raw materials cost. To get the full prime cost, we'd also add the other two direct components, the wages for the workers physically making the soap, and any direct expenses, like a royalty paid per bar. Once we have that total, we need to add the cost of the factory itself. These are the indirect costs, or what we call factory overheads. Now, what's really interesting here is the clear line that gets drawn. A direct expense can be traced to a single item. For instance, if you pay a technology royalty of 3 rupees for every unit you make, that's a direct cost. But an indirect expense, or overhead, like the monthly rent for the factory, supports all production. You can't say how much of that rent went into one specific bar of soap. And here are some classic examples from Mr. Vimmel's business. Things like the rent for his factory building, repairs for his soap mixing machines, the slow depreciation in value of the factory shed, fuel to run everything, and even the salary of the maintenance crew. These are all absolutely essential manufacturing expenses, but you can't assign them to a single product. So we have our prime cost, and we have our factory overheads. Let's move to the account itself and see how all of these different pieces come together to give us our final production cost. And this illustrates the flow perfectly. Think of the manufacturing account like a big bucket. On the left side, the debit side, we pour in all our costs, the raw materials we consumed, the direct wages, and all of those factory overheads. On the right, the credit side, we account for value, and the final balancing figure is our total cost of goods produced. Now, there are a couple of other important adjustments. We have to account for work in process, or WIP. This is the value of goods that were only partially completed when the year began or ended. They're not raw materials anymore, but they're not finished goods yet. We add the opening WIP to our costs and subtract the closing WIP from the total. Another interesting item for the credit side is a byproduct. In many manufacturing processes, creating a main product also creates a valuable secondary one. The classic example is making sugar, which also yields molasses. The sale value of that molasses is credited here, which effectively reduces the overall cost of manufacturing the sugar. Pretty neat, huh? So, after all that, we have our final number, the cost of goods produced. We've done it. But the story doesn't end there. Where does that number go next? How does it connect to the final profit of the business? This shows how the manufacturing account is the critical first step in the full financial story. That cost of production number it creates is transferred to the trading account. There, it's compared against sales revenue to find the gross profit. Then, that gross profit moves to the profit and loss account, where all the other business expenses are subtracted to find the final net profit. It truly is the first domino in the chain. But here's something really important for context. While this formal, separate manufacturing account is a fantastic learning tool, it's actually quite rare for businesses to prepare it this way in their final published accounts today. The components are more often just merged directly into other financial statements. And that brings us to the final, crucial question. The specific format might be a bit historical, but can any manufacturing business really succeed without obsessively understanding and tracking every single component of its cost of production? The principles are more important than ever. And that's what you should take away from this explainer. Understanding how these costs are built is a timeless and absolutely essential business skill.